Welcome to the Yorkshire Shadow MPC, a partnership between Clive Owen LLP and the York Press. 2 weeks ago, Rishi Sunak announced his landmark budget, which was designed to support those hit by the pandemic and also bring in measures to ensure the bounce back of the economy. Today I'm going to be talking to business leaders to find out how their sector's coping in these challenging times and ask if a change of interest rates would be beneficial to the Yorkshire economy and, if so, why? Maybe not, though. Let's have a look at some context. According to the national figures, GDP in January fell by 2.9%. This is OBR figures. GDP expected to grow by 4% in 2021. Public sector debt, £2 trillion. The interest on public sector debt, £50 billion. Government spending in the UK in 2020 was nearly £1 trillion. Unemployment's 5.1%, and there are 6.2 million people on furlough, which is the highest by proportion of the workforce of any country in Europe, actually. So let's have a chat with some of the people on our Shadow MPC. I'll quickly read out our cast list today. We have Robb Whitehead from Clive Owen LLP, Gary Smith from Tilney Financial Planning, Suzanne Burnett from Castle Recruitment, Delroy Beverly, who's representing the IOD and also works as MD at the York Teaching Hospitals Estates. He can explain that in a minute. Richard Peake from Helmsley Group, who's in property. We've also got Charlene Lyons, who's Black Sheep Brewery CEO. Welcome, and let's start with you, shall we, Robb? What are your clients at Clive Owen LLP saying about how they feel about the prospects of the economy?
Yes, hello, Robb Whitehead, partner with Clive Owen LLP in York. We've got a lot of clients across many of the sectors. But last year it's been particularly challenging for businesses in our region. Obviously, the leisure and retail sectors have been hit hardest. But we've seen a lot of businesses bouncing back, to coin a phrase, and recovering quite well from last year and getting back up to good levels of business, sort of pre-COVID levels. And we've even seen some niche businesses, doing better than they've ever done. And quite a few businesses have built up some cash reserves, which is always good in these times, although still cautious about investing and what the future holds. And I think there's still a lot of uncertainty around what will happen when the furlough scheme comes to an end later this year. But I think it's probably too early to be doing anything radical with interest rates.
Okay, we'll come to that a little later. Thank you very much for starting us off. Delroy Beverly from Institute Directors, member of the Institute Directors. Just before we start with what you think, tell us about the York Teaching Hospital, what the role you have there is.
Yeah, thanks very much. So I'm the managing director for a large subsidiary company that York Teaching Hospital set up 2 years ago. We employ somewhere in the region of around 1,300 people. Many of those people are frontline staff. So we provide domestic services, facilities management, capital works, medical engineering, car parking, security, a range of services to 5 hospitals around the region, as far afield as Bridlington, Scarborough, Malton, Selby, and York. Okay, so a real diverse range of individials.
So, you're at the front line. You've obviously got to continue planning, though, in the NHS. I suppose the kind of work you're doing goes on. There's hardly a break to put new plans in, but you've got to continue to plan for the future.
Absolutely, because what we've seen in the last 12 months, and just for the presentation, I've only been in post for 11 months. So I started at the height of the pandemic. So York Teaching Hospital and all our sites have seen firsthand the impact of COVID. In many cases, we've got employees working in amongst COVID wards and providing services and auxiliary services, so on. So I think it's important to me, and Rob mentioned that, a lot of people are blessed from having the furlough scheme, but many of my employees are either related to or live with someone who has been furloughed, and in many cases are not getting the full span of their wages. So we see firsthand the impact of that, not just in terms of our people, but what that means to their lives as well. So, you know, we're keeping a close eye on this, is what I'm saying in terms of our employees.
What is your taking away from the specifics of your role, looking at your IOD role, what are your members and what is your view, your personal view of where the economy is at the moment?
So I think the first thing is I'm the chairman for this region, so I'm the regional chair that oversees a number of individual branch chairs. So we're seeing a similar story. A lot, you know, we've got to remember, you know, the government talks about levelling up. Levelling up what? Certainly in the north of England, I've not seen the impact of that levelling up. A lot of our members are small, medium-sized organisations who have been impacted by COVID. So this upturn, or not, that people are talking about, many of our member organisations are not seeing that and are actually struggling to survive.
And do you think that, although they're not seeing it now, the prospects for the future, as some of the commentators are saying, including the Bank of England itself, are rosy? And we had the forecast from OBR of a 4% set of growth figures towards the end of this year. Although there might be not evidenced now, is the prospect a realistic one?
I mean, it depends what glasses you're wearing on a particular day, what you determine as rosy. When you're sat in Whitehall and looking around and seeing everything almost looking back to normal, the world looks rosy. But I always say go 40 miles north of Watford, and then suddenly that rose starts to tint a little bit. So in my mind, I think we are at least 3 to 5 years away from any sort of stabilization. Many of our organizations, if they haven't retreated at least 5 years, have certainly retreated quite significantly. So whilst I'm optimistic about the future, I'm maybe not as optimistic if I was sat in Whitehall looking through those rose-tinted glasses.
Delroy, that's great. I know as we record this, you've got issues at the business you have to deal with. It's very hands-on, as you've described. And if you do have to go before the conclusion of our vote, I know what your vote is and I'll tell people, but hopefully you'll be around. Gary Smith is next from Tilney Financial Planning. I suppose you might see a more holistic way of how the economy is working from the point of view of investments, Gary. What is your immediate take on things?
Well, wealth management, we're usually a very good barometer of how the economy is doing as a whole. So during the credit crunch in 2007 to 2009, we started to feel the pain during 2008 as people stopped making pension contributions, didn't fund their ISAs, had to withdraw capital to sustain their livelihoods. We're actually seeing the opposite at the moment. It's buoyant. So people have got cash for the first time, because if you have been fortunate enough to keep your job or getting 100% of your earnings on furlough, it's very difficult to spend at the moment. You can't go out and you can't go on holiday. So people have got cash. So we're seeing an increased appetite for funding pensions, funding ISAs. It's a particularly busy end to the tax year. And a lot of our people we deal with are already looking to advance their tax year planning to April for the 2021-2022 tax year. So they're going to do their pensions and their ISAs to benefit from any recovery in the markets, because whilst America did extremely well, predominantly on the back of tech stock, the UK is still lagging down around 8 or 9% from its highs last year. So the UK still hasn't recovered, and people want to be positioned to take advantage of that. So if we're a barometer, the economy's doing all right. A lot of the clients we speak to from a corporate perspective have high cash balances. So some businesses have done extremely well during the COVID period. And we also have people who have cash savings, and because interest rates are so low, they're actually looking to invest, transfer cash ISAs into investment ISAs, or just invest cash in general. One, to try and get a better rate than they can on their savings, but also to take advantage of any recovery as and when it comes, which hopefully we'll start to see in the Q3 and Q4 this year. Unfortunately, we do expect inflation to be an outcome of COVID for a number of reasons, but it's going to be an unusual circumstance where there's probably going to be an appetite for a period of inflation, because it's one way of dealing with the government debt. You can inflate part of it away. So you might find that traditional ways of controlling inflation, i.e. increasing interest rates, there might be a little bit of a lack of an appetite for that at the moment, because 2 or 3 years of increased inflation might actually help in terms of the increased borrowing the government have had. So,
okay, well, I'm going to pick you up on that if you don't mind, because I think you're probably the right panelist to ask about this, and a very upbeat assessment of where you see things as well, Gary. But on inflation, I was checking out our weekend business press. There were several factors rather, that suggest inflation could be a little bit worse than many of the forecasters suggest. There's a very interesting set of data from Joe Biden in America from last week. This stimulus package that passed is almost helicopter money. I was just looking, the rules of the game are that if you are a middle-class couple earning $150,000, you will get $5,600 just dropped into your account. Everyone working is going to get this individual check of £1,400 and more if you have dependent relatives at home. That's a lot of money, and there'll be a lot of money chasing the same number of goods. America will suck in imports, and that is inflationary in itself. And then there are other things that have been reported generally. Oil is now $70 a barrel or thereabouts. It was $40 a year or so ago. The cost of computer chips has nearly doubled. Containers, hopefully that's a temporary thing, but 1,500 quid to have a container, now 8,000, and I've heard quotes as much larger than that. And food prices going up. So the inflation that's in the system does appear to be real and tangible and not yet reflected in the figures.
Yeah, but it's even more than that. So if you think about the industries that have been affected by COVID, so hospitality, airlines, they work on tiny margins. Although I think it's April the 12th, where you will be allowed into pubs and restaurants again, and some capacity for outdoors, and May the 17th for the rule of 6. You're not going to be at full capacity. So the only opportunity those businesses have to break even or make a profit is to increase their costs. So inflation will come that way. The other thing which the markets are probably looking at is global central banks intervened pretty much nearly a year to the date, and they effectively put a bottom in the market when they spent about 9.6 trillion on buying government debt around the world. That gave a floor to the market, but we now have $9.6 trillion of money in the financial system. And if anything, as we saw with the credit crunch, that chased investment returns and markets and investment. So this cash is floating around now in the financial system. So that will lead to inflation. And as you've said, in America, it's one of the arguments from the credit crunch is, if you give money directly to people, they will go out and spend it. So I wouldn't be surprised if you see an upturn in the American markets today as those people who've got £5,600 choose to invest in Tesla or Apple stocks and such like, or they go out and spend it. And if you lend money to banks there's a lack of risk appetite. Banks are particularly tightened their belts on mortgage borrowing. So if you're self-employed, or if you work in the hospitality sector, if you're on furlough, you might find it very difficult to remortgage at the moment. Whereas if the Bank of England or the government just send out checks for £5,000, that would have much more impact upon inflation in this country. But so whilst it might be an issue in America, I don't necessarily think it'll be as pronounced in the UK, because we haven't followed the same measures.
And you don't think that there's any need for the bank at this stage to take any premeditated action and a preventative action to stop inflation taking hold, even though it's not yet there?
No, because it's not as a result of wages going up. It's not as a result of people having extra income to spend. It's a result of COVID. And like I say, it benefits the government because it inflates away their debt. So no, I don't see how interest rates would actually prevent the inflation we're going to get. Okay,
that's fine. Charlene, let's bring you in from Black Sheep Brewery, the CEO. Tell us how you see the world from your sector's point of view.
Okay, so hi there, Rob. Thank you. It's interesting, very interesting. I mean, we are waiting with bated breath for pubs to reopen, and as you said, Gary, I mean, it's going to be interesting. It's not going to be the same model that we or our customers were able to follow before. We're nervous about the amount of people capacity. We're nervous about how many customers will actually open their doors, because for some it's just not financially viable. And we're nervous about what the changing landscape of the pub sector looks like when it does reawaken. We're also quite cautiously nervous actually around the furloughing scenario. The majority of our staff are still on furlough. When they come back, they're coming back to a business that looks and feels incredibly different. That's going to be a challenge in itself. And one of the main things I think that we and other businesses in the hospitality sector have not been able to do well enough is look forward and innovate. I mean, we've done our very best, but actually for many businesses, investment is just not an option because there's just no cash available. So grants and opportunities for forward planning and forward thinking, things that really count, things that really matter, like sustainability, the changing landscape of the world that we operate in. We're just not able to find the cash to be able to invest in those things. And for us, like many, that's going to be a real challenge going forward. I mean, you raise a question about how many covers effectively can you have in a pub that is only open with outside space, and are we going to have to put our prices up? We can't, simply because, we as a small independent brewer are competing against, big players who will not be putting their prices up, which basically means that if we did that, we would cannibalize our business in a nanosecond, because our customers wouldn't buy our product at all. And nor do we want to do that to our customers who are, fighting hard to be able to open their doors and get their customers back in. So it's a really difficult kind of catch-22. It's a challenge. Well, I mean, we rise to that challenge, but it's a challenge.
I can tell people on the call here that you did rise to it at Christmas. My team got loads of the old gift packs that we bought through, and they were a very innovative way of doing it. So well done. Okay, we'll ask you about interest rates in a moment. Now then, where's Suzanne Burnett from Castle Recruitment? Hello, Suzanne. Are you managing to put people in jobs? Are people ringing you up with vacancies, or is it all slow?
Well, it's been interesting actually. The last 6 weeks has definitely seen an increase. I think schools being reopened again. We do a lot of education supply, which obviously just ground to a halt. But we're definitely seeing an increase in the daily and long-term supply jobs. But there is a shortage of people like supply teachers because many of them are still shielding or isolating. So, but hopefully vaccinations are improving on those. We've seen big demand for skilled manufacturing operatives, welders, fabricators, lots of engineering and general manufacturing clients. We're talking to, expecting growth in quarters 2 and quarter 3. And our, as I was saying, our engineering division's seen a big change in the last 6 weeks since the roadmap really was announced. I think people can see a way out of it now. And where we were struggling to generate candidates because, lots of people were hanging on to furlough, hanging on to stay at home, not wanting to swap jobs, they are actively on the job market and looking to swap now.
Okay.
And some of our sectors have just died, such as hospitality, absolutely nothing. But we are already speaking to clients about coming out of it. And we supply a lot of temporary workers, and lots of the clients are looking to take temps on, in the first instance, where there's all this uncertainty around it.
Can I just?
Go on.
I was just going to ask you, Suzanne, is there any indication of movement in wages in some of the places that you're putting people?
We are seeing some clients think that they can get people for possibly a little less wages at the moment because they think there's a lot of people on the job market. We would say that is not a good move because those people, once the job markets open up again, won't stay then. So that it's not really conclusive to a long-term relationship with a new employer. So
okay,
no, it's interesting.
Thank you, Suzanne. I'm going to the insurance sector now. DE Ford, is that Chris? Oh, Harvey. It says Harvey on your screen, so it confused me a little. It's Chris Greenall. Chris Greenall.
My son's infiltrated my system, which I apologize. January and February were interesting months. We saw good growth in January, February, year on year. So we went about 7%, and some of that was new clients coming to us. But like Robb's business, we have an eclectic array of clients, and some have been monumental losers in the last 12 months, but we've had some significant gains in certain sectors. So hospitality we've touched upon, motor trade has been a difficult part of the business. and recruitment has been difficult as well. But on the whole, the business has surprisingly seen a uptick in the last quarter of last year, and the first 2 months of this year have been, as I say, interesting and slightly refreshing. So things are looking up.
Well, that's good. Good to get some positivity. And in terms of your own employment situation, have you managed to be stable with the number of people you employ? And are people still furloughed?
I'm pleased to say that I'm still employed. But yeah, we haven't done any furloughing. We have a risk management arm that deals in health and safety. So they, for a period of time, were furloughed for obvious reasons, but they're now all back to work. And that part of the business is really taking off again. We are nowhere near the numbers that we were in 2019 and 20. However, or early part of 2020. But on the whole, we're seeing a very positive outlook for that side of the organisation. And other than that, we've had no furloughing in the organisation. Clients are still there, and they still need looking after, even though we have seen a downturn in turnover, wage roll, etc. They are still there on the whole. And interestingly enough, we haven't seen too many companies go into administration or liquidation. However, the major challenge for the business is our credit control and actually trying to get money out of clients is proving the challenge that we are facing.
Well, you're the first person to raise that, and I know from my own business that's something I've noticed as well, but thank you for raising it. It's something it takes guts to be honest about that as well, so thank you very much, Chris. Last but by no means least, let's go to someone in property, and we've got Richard Peake from the Helmsley Group, who invests in property. Richard, have you taken the opportunity to invest as commercial property,
to be honest,
housing?
No, absolutely. I mean, I just endorse a lot of what Gary said earlier on. Frankly, we haven't been busier for a long time. We're seeing positive signs of growth on all the aspects of our business. We have everything we do is based around property. We've been working in York for over 40 years or so now. We buy well-let commercial investments, and we're seeing a large number of opportunities around that sector at the moment, particularly with some of the London investment funds looking to offload some of their stock and take sort of a stock on that side. We also do property development in our own right, basically either specialising in the starter unit end of the market or the very high end side, and both have seen fantastic levels of sort of inquiries and sales going through. So very, very positive for the future on those sides. And lastly, we also lend money to other smaller developers around the country. And even through the lockdown times, we've seen our borrowers still being able to continue get sales and completions going through, and so loans thankfully coming back in and being repaid to our client investors. It went a bit quiet, obviously, when with lockdown 3 at the start of the year, but we've suddenly seen a huge increase in inquiries from developers looking to sort of kickstart schemes from that side. So yeah, we haven't anybody on furlough. We've employed 3 new members of staff since the new year.
Okay, Richard, I'm going to ask you one more question you might not have the answer to, but south, north and west of you, York, Teesside and Humber, there have been some major investments, or announcements rather, that could have an agglomeration effect. You've got Freeport to the north and south of you, you've got the Treasury relocating a section of its workforce to Darlington, and then Leeds, you've got the National Infrastructure Bank. Do you think, you're surrounded by that at 50 miles either way on as you drive? Does that have an effect on York?
We, as I said earlier, we focus in the sort of mainly the higher end sort of residential side of things. So, and frankly, York is a beautiful city to work in, but also to live in. So, we would certainly expect to see an increase in demand from relocations and people from that side. So, it can only be a good thing as far as I'm concerned.
It's time for a show of hands, ladies and gentlemen. The question is, does anybody feel that interest rates should or even could be cut to negative rates? First, show of hands for that. No. does anyone feel, particularly in the context of inflation that we were talking about earlier and Richard lending money, that interest rates could be raised even a modest amount, 0.25%? Yes or no? Hands up. And what is the appetite for keeping them as they are? Hands up. And Chris, I didn't see your vote.
I think they will go up.
You think
not a big going up, but I think they will go up.
So what would you vote for if you were on the MPC?
I would put them up.
You would put them up.
With inflation.
There we are. It's a free country. Everyone's, you know, you might be in a minority of one, but a minority of one can still be right or wrong. It's very interesting to see. Ladies and gentlemen, thank you very much indeed for joining us. That's the conclusion of this month's quarterly discussion with the Shadow MPC for Yorkshire in conjunction with Clive, Owen LLP and the York Press.